Welcome to Stock Talk with Nico Kritikos. Today we're going to be doing an update and a stock analysis for Ollies stock. This is a mid-cap company that is a discount retailer. I made a position in this about 2 months ago, and the stock is down from its highs of $109 to now about $64 a share. So we're going to go through some analysis, do some competitor comparisons, and see where this stock is headed in the future. So right now they have 430 locations. The CEO said in 2019 that they can get to 950 stores. That is their goal. And they've been adding roughly 45 stores per year. So each store averages about 4.3 million in revenue. And they have about 11% profit margin, which is, as you'll see here, higher than all of their competitors. That's $430,000 of profits per location for every year. The CEO also said that the store pays back for itself in under 2 years, which is very nice. And then this company is growing, expanding locations. And last month they hired over 3,000, or they had a hiring event for over 3,000 positions. So good things are looking good for this company. Here we can see a bunch of different similar companies. I mean, some of these Macy's isn't really similar, but I just wanted to compare it. Whatever is highlighted in green means that company won that category. So as you can see, Ollies has the highest return on invested capital, the highest profit margin. For revenue growth, they're in second place, only to Five Below. And then price to sales is just Big Lots has the cheapest because they're not growing anything next year, but Ollies is growing 12%. So that's the difference there. But as compared to these dollar stores and these other discount retailers like BJ's or Five Below, I mean, they're in a pretty good position. They have a very high return on capital. Then if we go down, we're going to see my pretty much my stock price prediction for the future based off of past metrics and where it's traded at in the past. It's been very volatile the last 2 years. We've seen $38 a share in 2020 and $123 this year. Now, earnings are supposed to fall in these next, like the comps for 2022 compared to 2021 are supposed to be down a little bit just because people were stocking up for things during the pandemic, and that's what really boosted their sales. That's why net income in 2021 was so high. So if we look at their equity stake, we can see it's been growing nicely over the past 3 years. Return on invested capital has been anywhere around this 14 to 20% mark. Their store count has been increasing gradually, and net income has been increasing as well. And then revenue has been increasing as well. P ratio is a decent amount cheaper than where it normally trades. And then I took the average share price for each year. In 2019, it was an average of $85 a share, 2020, $75 a share, and this year it averaged $91 a share. So as you can see, over the past couple of years, it normally does not trade this cheap. It normally trades, above $70 a share, above $80 a share. So that's why I think this is undervalued. We can also see what the numbers will look like, in my opinion, when they do reach that $950 mark or 950 store count mark. And if they're adding about 45 stores a year, it's going to take about 10 years for them to hit that. And let's say their equity increases at a stable rate during that time, they'll have $4 billion of equity. Return on invested capital should be somewhere around this 20% mark, like it has been. And then net income will double as well to $400 million, because if you have 950 locations doing 430 grand in profits, then that will give you $400 million. And revenue will be about $4 billion, which gives it a P ratio of 10. The company's not going to have much growth after that. So everything's going to be pretty much priced in as long as the management can execute. And the average share price will be $307 at this valuation. It'll be a $20 billion company. So that's if they execute, and it looks like they have been executing. They've been opening stores. They've been hiring. Sales and revenue, profits have all been increasing. Return on invested capital is higher than competitors. And so that's where I see this company going in the future. In the more shorter term, I see for 2022, their store count should be about 475. Net income is supposed to drop a little bit, but still higher than where it was before the pandemic. Revenue will be $2 billion. The P ratio is going to be around this 23 mark. And then the average share price will be probably about $88 a share. So that's where I'm expecting this stock to go, from 64 to 88 at some point, maybe 6 months from now. and that'll put it at a $5.7 billion market cap. I mean, my whole thing is, if this company is traded at such high prices in the past with so much less on the balance sheet, so much fewer stores, less income, less revenue, then there's no reason why this company can't be trading at $80 or $90 a share right now, because they have much more equity, they have much more stores, they have much more income, revenue, and so that's why I think this is easily a $90 stock within the next year. So yeah, that is my analysis on Ollies, and let me know what you guys think down below.